Hello everyone, I'm Sahil and welcome back to the channel. Today we are looking at JD.com's Q1 earnings results. I have already done an in-depth analysis for JD.com in one of my prior videos. So if you're interested or you haven't watched that, I would highly suggest that you go on and check that out before moving on to this video. If not, I have divided this video into 5 different segments. Firstly, we'll be looking at the financial performance. Then we'll go into some of the highlights that happened in the first quarter. Followed by the management's view on what happened and what is going to happen. Then I'll give you an overall summary, followed by the main question: is it a good buy? Is JD.com still a good buy? I think everybody's thinking that, right? So let's get it rolling. Alright, so like always, let's look at the numbers first. So here we have the Q1 earnings for the last 3 years, which I pulled off from Capital IQ. You can also do it from Yahoo Finance or other website like Morningstar. And yeah, so if you look at the top line, the total revenue, it increased by 39%. Now we were expecting about 30% growth, so this is definitely amazing. And also until the last earnings, JD used to report 2 different segments. Firstly, JD Retail and New Business segment. Now they have made some changes. Firstly, they have pulled off the Jingxi segment, which is their lower tier market, different projects that they have in the lower tier market, like community buying services and all those things. I've talked about it in my in-depth video, so yeah, that's why I suggested like go watch that, because I'm not going to cover every single detail and it will be easier for you to understand if you have watched that video. So they have pulled off Jingxi from JD Retail and moved it into New Business segment. I believe they did it because they were expecting huge losses from Jingxi going forward, and they didn't want to mess up JD Retail's figures. And yeah, also JD Logistics, which was part of a New Business segment, now is reported separately. I think this is great because we get more data and we can understand the company better. And if you ask me, I would rather have them report all the various segments separately, like, Jingxi separately, JD Technology separately, so we can know what is really happening, how much growth is there or how much losses are coming from there, what are the margins of the individual companies. But, well, we have to work with what we have. So looking at into the individual segment, right, JD Retail actually increased 35%. JD Logistics increased 64%, which is awesome growth, definitely. And New Business segment, it grew by 56%. Amazing again. So this last line item, which is inter segment, this is really just the internal revenue that is generated by JD Logistics. So they JD Logistics also serves JD Retail and Jingxi, right? So they have to pay JD Logistics. To adjust for that, they would minus it off over here, and then we'll get the final revenue. So yeah, again, so JD Retail, right, represents 91.4% of JD's Q1 revenue, and this definitely tells that JD Retail is the core business of JD, and it is the main part of my investment thesis as well. The rest of the businesses are just there to actually support their core business. The only outlier I see is JD Health, which I don't know why they went into. But anyways, if you move on to the gross profits, the margin decreased from 8.3% to 7.3%. This could be like there's an increase in revenue generated by Jingxi, right, which is a lower tier market, and the ticket size are smaller, the margins are smaller. So the product mix now is changing. So that's why I think the gross profits are decreasing, in my opinion, and I think going forward this would be the trend. Also, we look at the operating income margins, it decreased from 1.6% to 0.8%, but this doesn't really bother me because it's still in line with the pre-pandemic levels. Last year was just an outlier because well, JD was preserving cash due to the pandemic and they cut down on their expenses, the marketing expenses and the R&D expenses, to be particular. But this year they are back on, and the marketing expenses actually increased 56.6% since last year, and the R&D expenses increased 15.1%. Moving on to the net income, it practically tripled from last year, and this is amazing to see. But what exactly happened? The biggest reason seems to be the income from the affiliates, and if you check the earnings report, right, it is basically contributed by the JD Technology consolidation, and like I mentioned in my in-depth analysis, right? The JD Digits was merging up with the JD Cloud and AI to form JD Technology, and yeah, that's what really happened over here. It was completed in Q1 this year. JD Group as owns 42% of JD Technology now. But anyways, we should put more emphasis on the operating income because that is what gives us a bigger, shows us a trend on how JD is performing operationally. The net income is just corrupted by all the other one-time expenses, inflow or outflow, which doesn't really shows us the trend. Of course, it's good if there's more inflow than outflow, but it doesn't tell us where JD is going or what is happening. So if you look at the operating income, again, JD has provided us with the individual segment information to compare for the last year. So JD Retail, its operating income margins improved from 3.7% last year to 4%, which is great to see, but I don't want to draw any conclusions from here because we only have 2 years of data, and really last year was an outlier. So I can't really draw any conclusions from here, but it's still great to see that the margins improved. JD Logistics and New Business both saw huge losses, and this is quite consistent with what JD's management is trying to do. They are more focused on growth instead of profitability at the moment, and yeah, it is what is expected out of these two business segments. Right, so with that covered, let's move on to the highlights of the Q1 earnings. And firstly, talking about the revenue drivers, which for JD are the number of active users and the revenue generated per user, which is called the ARPU. In last quarter, they finally crossed the 500 million mark in active users, and that was a growth of about 29% quarter over quarter, which is amazing to see as a number. 81.1% of the active users came from the lower tier market, and obviously these users have lower spending power and you can expect the ARPU to drop. However, the retail CEO of JD mentioned that the ARPU was actually improving together with the shopping frequency and retention. This is mainly attributed from the fact that a lot of people, they are moving out into the lower tier cities where the infrastructure is improving now and coming closer to the higher tier cities, but the prices for properties are still lower. In the higher tier cities, it's just blown up. Like if you talk about Shanghai, so a lot of people are now moving there, buying properties, new properties, and which requires new home appliances, which is one of the advantaged segment for JD Retail. So as people buy these home appliances, which are expensive products, it is improving the ARPU for JD. So yeah, that is the main contributor. And moving on to the second highlight, which is the direction that the company is taking going forward. So if you see the earnings report, right, the first thing you notice is that they mentioned that they're moving from a tech-driven e-commerce player to a supply chain-based technology and service provider. This has been mentioned since last year Q1. What this means is that they are trying to move away from their traditional retailer business model, which buys inventory from the brands and sells it to the end consumer, to becoming a host to these high-end foreign and local brands, and also provide them with the full spectrum of service from warehousing, logistics, and other value-added services like marketing, home installation, and after-sales services. They are really growing into this space, and the revenue from this segment, the service segment, is up 73% year over year. This strategy, I feel, will particularly attract brands that do not have presence in China yet, and they do not want to go a path of the asset-heavy business model where they would have to invest in office space, physical stores, and even supply chain. JD can provide them with this entire integrated ecosystem that covers everything that the companies would need to sell their products to the Chinese consumer online. So, which is great, right? Everybody wants access to the Chinese consumers. The market is huge, and JD is able to provide them everything that they need in order to do that. So yeah, JD's offering is reducing the barrier to entry to such brands who want to come into China, and at the same time, it has the ability to make JD an exclusive host to such brands. If this is done at scale, right, and there's a lot of brands that consumers love, and it's exclusively on JD, they don't have any other choice but to be a user on JD, right? And this will give JD a competitive advantage going forward. So yeah, it is something to look at. and if they are able to pull it off successfully. It is also attractive to traditional high-end players who so far have been reluctant to go into online and have online presence because they want to protect their brand image. However, now JD is able to offer them fully customized storefronts, and at the same time they offer them white glove services. Like, the delivery personnel will come in suit and tie with white gloves to deliver your product, which upholds the luxury appeal for our product. So JD is able to offer that, which currently Alibaba cannot. A number of luxury brands have already established a flagship store on JD's platform, and in April this year, JD and Louis Vuitton launched a new collab, further boosting its position as a premium marketplace. They have also attractive exclusive partnerships with a wide spectrum of other brands such as John Loeb, the luxury shoe and boot brand under the Hermes Group, Italian brand Marni, I don't know how to pronounce it, so along that line, not only launched a flagship store on JD.com but also adopted a customized one-stop solution offered by JD.com covering marketing, technology, supply chain management. With this service, customers can purchase directly from Marni's inventory with the products delivered by JD Logistics. Now, I understand that the word exclusive might instill fears of government scrutiny, like what happened with Alibaba, right? However, don't be worried. JD is not forcing these brands to be exclusive to them. It's just that JD is presumed by the consumer as a premium marketplace. If you compare it with Tmall, it is at the higher end. So these high-end luxury brands, they want to be associated with them instead of Tmall. So they, in the end, are exclusive to them, right? But it's by their choice. Also, JD is able to offer them the additional services that we mentioned earlier, which makes them an attractive place for such brands. All the success makes me believe that JD still maintains a competitive edge over Alibaba as a premium marketplace, even after the Farfetch deal brought the business from the Richemont Group to Alibaba. Richemont Group is a big group of a lot of luxury labels, and they invested, Alibaba and Richemont Group invested in Farfetch together. And I would assume that now Richemont Group would like to exclusively work with Alibaba. But let's see what happens going forward. However, JD working with the LV Group and Hermes Group, which is also huge groups, will balance off the power. So this is great to see. Now, this is just the fashion side, the apparel industry, but they have also been getting stronger in the consumer electronics sector, and they had hosted product launches in the pandemic for brands like Honor, Xiaomi, Oppo, OnePlus, Realme, and other brands on their JD Home platform. Now, the third highlight we are going to discuss is the logistics expansion. JD really believes that logistics dominance is the key to the long-term success in the e-commerce market. And it also provides them with a competitive advantage, as companies can't build an integrated supply chain and a distribution network overnight. I believe Alibaba's Chinnao, or I don't know what it's pronounced, I forgot. But over the top of my head, they have about 200 plus warehouses, where JD today has 1,000 plus warehouses, which is a huge difference. I mean, JD spent over a decade building this infrastructure, so it's going to be very hard for other companies to catch up. And they were doing this while other people were actually saying that they would burn. Even Jack Ma mentioned that what the business model JD is adopting is going to end up in tragedy. However, they managed to pull it off, and they are not stopping. So yeah, this is something that really you have to give it to JD. They recently invested another 800 million USD into Dada Group, which supports JD's last mile logistics, mostly for the fresh produce. After this deal, JD's stake in Dada Group now stands at 51%. Also, JD Logistics has grown to 100 plus warehouses, like I mentioned, roughly 10% increase in the 3 months, which is amazing growth, and they're doing it very fast. JD Logistics was also going public this month, like I mentioned earlier, and they're raising about 3.4 billion USD, which will be further invested into growing the logistics capability. By the way, I have already made a video on JD Logistics, and you can find out more information on them from that video. I will link it down in the description below. You can watch it after this video, and only after this video. Finish this first. All right, so yeah, we are done with the highlights, and now we can move on to the management's view and what they talked about in the earnings call. According to the management, JD is committed to authenticity, high quality, and fast delivery. This is very apparent from what they have been doing, and we have discussed earlier. The JD Retail CEO mentioned that the third party or the 3P marketplace space remains a huge area of growth potential for JD going forward. That's why they are now focusing on that area, like I mentioned earlier, the change in the business model and the strategy. So yeah, in particular, the growth in the 3P retail exceeded that of the 1P in this quarter, and the growth rate of the apparel and beauty segment of the 3P marketplace was at a 3-year high, which is awesome. Even the FMCG, the fast moving consumer good, and home appliances category, which are JD's biggest revenue generator as a 1P marketplace, uh, showed a high growth in 3P marketplace segment as well. They don't give us the exact numbers, but that's what they say. The management expects JD Retail to maintain its high and healthy growth going forward in 2021. And the CFO mentioned that the 35% increase in the revenue for JD Retail on top of the relatively higher base of 2020 is really a robust growth. And she said they are rolling a snowball down a long slope, and they continue to build a momentum. She also said that internally they evaluate the performance of their businesses looking at a 2-year compounded annual growth rate, which smooths out the disruptions caused by the pandemic. JD Retail did 27% 2-year CAGR, which is double that of China's overall online retail growth, and that is amazing. The 2-year CAGR of the total service revenue, which includes the 3P marketplace business, was at 51%, which is significantly higher than the 21% of JD's 1P retail. Now, this is mainly driven by JD Logistics' triple-digit revenue growth from external customers and over 60% growth year over year in advertising revenue. As a result, the service revenue contributed 13.7% of the total revenue, up from 11% in Q1 2020 and 10.3% in Q1 2019. Going forward, 3P Marketplace is going to be the key driver for JD's improving net margins in the retail business segment. So yeah, this is consistent with what we talked about in the new strategy that JD is adopting again. Talking about the new business segment, it saw high growth across all the businesses under that, with an overall CAGR, 2-year CAGR of 42%. And talking about Jingxi in particular, according to JD, its competitors, namely Pinduoduo and the one from Alibaba, are focusing on new user acquisition through heavy subsidies, while JD is it thinks that the key is again the supply chain capability and logistics infrastructure. They believe that it gives them better margins than the competitor while not sacrificing the quality and customer experience. So JD, according to them, is not competing off-beat from the other platforms, but taking the long-term approach by investing in the infrastructure. At the same time, they have something more to offer to the merchants on their platform other than just the online traffic. So like they can also ease their burden by offering them logistics and all those integration. So yeah, I believe overall as a trend, right, all the companies in China are like they see something working and then they start copying. So Pinduoduo came up with the community buying business, and then Alibaba and JD jumped onto that. Whatever starts working, everybody starts to copy. So it is a very competitive industry at the moment. So let's see who wins. Obviously, like, you know, everybody's taking their bet. I have a friend who's focused on Alibaba. I'm doing JD, and yeah, if you're watching it, obviously you're gonna comment down below. But anyways, let's get back to the topic and move forward to the third business segment, which is JD Logistics. The management covered it pretty quickly by saying that it's still in a hyper growth stage and they need to expand not just to cover in-house transactions but also support external customers. Hence, profitability for JD Logistics is going to suffer. It's expected to suffer for the couple of years to come. Also, they covered the recent chip shortage in the world, creating a bottleneck in consumer electronics sector. However, they said that JD is preparing by stocking up on some of the sought after products ahead of time. That's why you see a huge dip in the cash position of JD. However, this will help them to be less affected platform compared to the competitors in the time to come. Alright, so that is the end of the highlights. Now let me just summarize everything for you guys. Overall, I think the earnings were good. The user growth is in line with the long-term numbers. However, it is showing a linear growth instead of an exponential one. That is okay. However, the Q1 growth is a bit disappointing for me, especially considering, I mean, I was expecting a bit more from the JD Tencent collaboration on WeChat. However, didn't get to see that. The collaboration started 1 quarter before, so I was expecting it to contribute a bit more this earnings, but yet again, it didn't happen. Now, the management, like I mentioned, is defending itself by saying that they are focusing on the long-term infrastructure development instead of quick user acquisition through subsidies. That sounds good, and I agree with them. It's if that's the truth, but it could also be an excuse, and only time will tell us what is happening. If you look at the absolute numbers, right, Alibaba gained 32 million active consumers, whereas JD.com gained 28.1 million active customers in 3 months ending March 2021. In the past 1 year, Alibaba says that it has 70% of the user gained from the lower tier cities, whereas JD says that it had 81.1%. So if we just take those figures to estimate the numbers that came from lower tier cities in the last quarter, we would have 22.4 million for Alibaba and 22.76 million for JD. That is around the same number. But if you notice that I use different words like active consumer for Alibaba and active customers for JD. Now, JD defines its active customers as accounts that have made at least one purchase in the past 12 months, whereas Alibaba defines their active consumers as number of customer accounts that place one or more confirmed orders, regardless of whether the buyer or seller settles the transaction. So there is a slight difference, right? Now, what this means, I'll let you guys decipher. You can tell me in the comments below, like who is overstating the numbers, like who is understating the numbers. So yeah. However, I would say that I really wanted to see JD doing much better into this space to really prove that the competitive advantage that they always mention about having a superior supply chain network and logistics is really working in their favor to drive up the revenue. Yeah, but whatever, we have to see the long-term trend in this. So let's see what happens in the future. But going forward, Q2 earnings are not expected to be as good as Q1 earnings in terms of the growth numbers. The management hinted the same. They mentioned that the first half 2021 growth would be in line with the last year, which was at about 28%. This is because they believe that the sales in Q1 2020 last year was dampened by the pandemic, and it was released in Q2. So we saw a lower number in Q1 last year and an increase in sales in Q2. So we have a higher base number in Q2 last year. With that in mind, if we do the calculations, the quarter two year-on-year revenue growth should be around 20%. So with that, we are coming to the end of the video. And now the big question is JD still a good buy? Well, for that, let's go back to the discounted free cash flow model that I did for JD for the in-depth analysis video. And the target price for that is at 352 HKD for head shares and 90 USD for the ADS. This has changed slightly since last time because of the currency fluctuation, but I have not changed anything in the model. And at the current price, JD is at 280 HKD, which implies that it is selling at a discount of 20% from its fair value that I calculated. And this is when we have expected the growth rate in the revenue for this year at 24.8%. But at the 28%, which the management is unofficially implying, it is higher, and that means the fair value should go back slightly, $1 or $2. So I would say that it's still an amazing buy, and since last time the discount is actually more. So yeah, me personally, I currently hold about 100 shares at an average cost of 338 HKD. I also bought 50 shares for my dad at a cost price of 270 per share. So yeah, that's my position. If you'd like to share your position with me, feel free to do that in the comments below. And with that, that's the end of the video. Until the next one, ciao.